Hey, what's going on, guys? Just want to do another update on Fubo. You guys have been awesome the last couple of videos. They've been some of the best performing ones so far. So huge shout out. Thank you guys. As always, hit the like and subscribe button. There's a ton of you watching that aren't subscribing yet. So if you could just tap that, that would be a huge help to the channel. And this video, it's going to be a bit longer. This was a podcast. It's actually at a live event that David Gandler went to, but it's a podcast on Streamtime Sports where David fields some questions. So this one will be a bit longer, and I'll just kind of fill in some commentary. Yeah, let's jump right in here.
So let's jump straight into it. Firstly, you had your recent earnings call, which was a chance for you to talk about the numbers for the previous financial year. Talk us through some of the top line numbers there that really stood out for you, that show that the trajectory you guys are on right now.
Yeah. Well, first of all, thank you for having me here. It was a wonderful 2023. We delivered almost 30% top line revenue growth. We delivered about 14% increase in ad revenue. Overall, subscribers hit another record number of 1.6 million. So I think it was a pretty remarkable 2023, given all the disruption that's happening in the space.
Some pretty good numbers. Top line growth, more efficiencies on the cost saving side. So all the things you'd want to see on your earnings call coming through for shareholders. Yet, when you announce those numbers, the share market doesn't always react the way you would expect.
I think it never reacts the way you expect when it comes to Fubo.
I think over the last couple of earnings calls, I've seen that similar reaction. What do you think do you have any idea or any sense as to why, I guess, the market reacts in such a way where you guys are above guidance almost every time?
Well, I think to be clear, we've exceeded guidance or expectations now 11 out of 12 quarters as a public company listed on the New York Stock Exchange. I don't know of any other media company that has come even close. We've improved our adjusted EBITDA by $100 million in 2023 on a mere, when I say mere, relative to what some of these big companies are doing, but on about 1.2 billion of revenue. So if you think about some of the larger media companies that are doing 20, 30, 40, 50 billion, sometimes I'm shocked why they're not doing as well as we are. So yes, it is shocking, but I think, Fubo has really defied gravity for 9 years. And every year it's the same old story. Well, Amazon's coming out with Thursday Night Football, you're dead. YouTube's coming out with Sunday Ticket, you're dead. So no matter what we're doing, I think that the market has a hard time understanding, well, how can we ultimately survive? So I think really it comes down to whether or not people believe you're relevant, but over time they run out of reasons to say but, and you end up being an integral part of the market.
One of the things you've been very clear about is your goal to be have positive cash flow for 2025.
Yep.
How's that tracking for you?
Well, I mean, clearly we're tracking, as we had stated back in 2022. We continue to improve our cash flow seasonally, year over year, every single quarter. That has happened now for, I think, the last 6 quarters. We've also beat expectations on the bottom line. So far, we think we're very comfortable with our current plan.
So for a while now, we've seen the industry shift from a growth-first strategy to a pragmatic growth strategy, let's call it. And you've clearly identified that across your approach with the business. Looking towards your plans for next year, some of the projections for me, I thought they were interesting. I wanted to get your take on them. The expectations on growth we're looking at, I think you're around 1.61 million subs this year.
For 2023.
Yeah, for 2023. And projecting to grow to but somewhere between 1.67 and 1.68 million subs for next year. That growth isn't a huge number of growth in subscribers. Right. Why have you decided to, say, tone down the the growth expectations on the sub side, is the focus more now going to be on real cost efficiencies and just making sure the business is stable, or is there other concerns or headwinds that you're facing?
Well, last year I think we started the year the same way. I think we had roughly forecasted about 5% growth and finished well in the double digits. So there's some elements.
I really hate that answer. They always sandbag the crap out of their numbers, and he's basically saying, like, yeah, we're sandbagging again, which is good because they're setting themselves up to exceed guidance again. It's just a little frustrating. But, to some of the other points before, there's definitely been this shift towards not so much just the top line growth, but really hitting that profitability. Like Andler said, they've beat earnings the last 11 of 12 quarters. They're continuing to execute and really focus on that free cash flow goal of 2025. They're still on it, which is awesome to see. But they're really, it feels like they're still focusing on a lot of those cost efficiencies over the next, year or two, to really hit that goal, and probably sacrificing some of that top line growth.
Element of conservatism in our numbers, just given every week there's some new piece of news out there that changes everything. And again, we're one of few companies that continues to forecast, whether it's on advertising, whether it's on subscriber growth. We feel very comfortable that we're able to deliver on the numbers that we have forecasted. And I think the other piece is, if you're going to hit cash flow break even, you really have to focus on the revenue side, less the sub side, because subscriber models require a lot of money invested in the beginning, right? Because so you invest money today, and then there's an LTV over the long term. So obviously investing more into the front end will cost more initially. Personally, I would do things slightly different, but as a public company, we have to deal with shareholders, and we need to be fiscally responsible, and we have fiduciary responsibilities. So that's why we've been a little bit more conservative.
You talked about news in there. There's been a lot of news in the industry over the last few months, and one of the biggest stories that hit the 2024 newswire was the announcement of the joint venture between Warner Brothers Discovery, Disney, and
You mean
Fox.
the sports cartel?
The sports cartel. What was
I am a thought leader.
Yes, absolutely. So
He gets kind of sassy in this interview. I know Wall Street typically doesn't like it, but he's not wrong in a lot of these comments that he's making. It'll just, they got to pony up and show that they can, show investors and really show the stock price what it can do long term. So I'm obviously bullish on this stock. I think we're still going to be kind of in this lower zone for a little bit before it starts trading up. But we'll kind of see how it goes. Oh, also, I assume most of you are bulls, but just comment if you're a bull or a bear on Fubo. I'm really kind of interested just to see who the audience is on here.
let's talk about your initial reaction when you heard that. Was it a surprise?
I'm not surprised. This is just the latest example of a pattern of bad behavior that we've seen since we launched the business. Again, this is part of the reason why you said, well, how do you have so many great quarters? I mean, let me just break it down to you. I mean, since this is a sports conference, I'll use Moneyball as an example. When you apply Moneyball analysis to Fubo, what you'll find is that our revenue per employee is what in 2003 was $3.3 million. You can fact check that. To put that into perspective, Netflix, which is obviously a highly scaled business, is roughly 2.6 million of revenue. And Spotify, 1.8 million of revenue. And our friends over at Roku, 1 million. And just to give you a social media stat, Snapchat's around $900,000. So it took us 7 years to get to 1 billion of revenue. It took Netflix 10 years to get to 1 billion of revenue. It took Spotify 7 years as well. So everything we're doing very well. So the question is, if you're so effective and so efficient, and you have 11 straight quarters or 11 out of 12 quarters of exceeding expectations, and you've had the foresight in terms of feature sets like multi-view, and really focusing on sports as a way to really build your base, then you tell me, What's the problem? What can it be? And the answer is simple. It's that we're being overcharged, 30 to 50%. We're dealing with,
A couple of those points he just touched on, really kind of interesting, because he said, in a subscriber model, it's very capital intensive up front. You really find those efficiencies once you're, really at scale. The fact that he just kind of touched on that point, they're a very efficient and lean organization already. That like $3.3 million of revenue per employee is huge, and the fact that they're really still in the early stages of the business, operating this efficiently, just shows that they really have a stacked team that knows what they're doing at the company, and it's showing already. But it'll be interesting to see how how their efficiencies continue to improve as they further scale and grow the top line revenue, but really zero in on growing out their ad revenue business.
Complexities around packaging. I'm not going to get into details of it because there's a lot of complexity there, but we're forced to take on content that we don't want in order to access must-have programming. When I say must-have programming, it means that 80% of the sports content that the CFO of Disney said that they would have at launch. And then there are other restrictions, right? We don't get to carry ESPN Plus, although we pay more per subscriber than anybody out there. So there are things like that, elements that I think are, have been unfair. And again, we're not, I'm sure some of the other executives will say, they're just crybabies. We're absolutely not crybabies. We're more than happy to take them on head to head, pound for pound. But, we're just looking for equitable terms. Again, would you be okay if, American Airlines, United Airlines, and I don't know, JetBlue or somebody decided to buy Boeing? How would we feel about that? Or if Citibank, JP Morgan, and Bank of America said, you know what, we're going to launch an online digital bank. So all we're saying is we want equitable terms. We're happy for consumers to have as much choice as they want. But for the last 7 years, we have provided consumers with a streaming service that was significantly more effective and efficient than cable. So we just want to continue that process, and we're happy to do that again on fair and equitable terms.
One thing I like, Gandler keeps messaging with a lot of these, like the earnings call and some of these other interviews he's doing. They're using this lawsuit almost as a PR move, because they're really, obviously they're fighting for better terms with the sports cartel, he calls it. But they're really using it to draw attention to some of the greed going on with some of these larger legacy companies that they're paying for this content, and it's really impacting the consumer. And I like how Fubo is kind of leaning into that and showing that while it will help their business with favorable outcome of this lawsuit, it's really for the consumer in the end, because people are essentially overpaying, paying multiple times for the same content. And he kind of goes into that a bit more later too.
So you released the press release a few weeks back with regards to the fact that you have actually launched a lawsuit against the venture.
Yep.
You mentioned some of the reasons there, but why decide to take it to that extent, I suppose?
Well, I mean, you see the news yourself. Every week it's something new. They start with Plus services. That doesn't work. They call Verizon. They bundle it, with other services. That doesn't work. I mean, they basically are throwing everything at the wall and hoping something sticks. And, if you don't have any competitors, guess what? It's going to work. And so it was a clear opportunity for us to be able to communicate what we're actually dealing with. It was very difficult for us to go in and talk about each of these companies individually. But, when you aggregate 80% of sports, it makes a much, much easier discussion for us to have as to why there is clearly anti-competitive impact here.
And that really kind of feels like the situation that they're in, where you said they're just kind of like throwing shit against the wall to see what sticks. Disney and Fox and Warner Brothers, they're massive companies with tons of money, but they are kind of on the defense right now. They're trying to figure out how to stay relevant They obviously have great content, and so they're really just trying to steer the market in only their direction, to where they're minimizing the choices that the consumer has. And so it's really just kind of shady the way that they're going about it, to essentially have this joint venture to force everyone to this one program where they can price everything well below everyone else. But it really does feel like they're kind of running out of options. A lot of those, if you look at the stocks for Warner Brothers, Fox, and Disney, they've had a rough couple of years, and they're really grasping at straws at this point to figure out how to continue to stay relevant.
So you've intimated, but just to be clear, in terms of the competitive nature of the platform itself, you talked about the conditions which you're currently under is the main issue, not necessarily the launch of the platform. What impact do you think?
I don't think we've ever said. I mean, look,
and that's a big point too. It's they're not necessarily trying to fight the JV and keep it from happening. I think Fubo probably executes their strategy more efficiently than their competitors. But it's really about getting the better terms. And, if they do have success with this lawsuit, that's going to be massive. The stock price is going to show it, because that essentially proves the business model. And, they'll be cash flow positive as soon as they have those favorable terms.
When we started this company, we were up against Sony PlayStation Vue, which, by the way, if I'm not mistaken, they complained to the DOJ back in 2014, and they're no longer here. So note to self. There was T-Mobile's Vision product, Amazon Thursday Night Football, Peacock, Paramount Plus. People still want to use an aggregated platform, and we've been very focused on ensuring. I mean, we talk about friction and fragmentation now for, I don't know, since 2020. We've been the first to talk about the rebundling in our shareholder letter of March of 2021. So, from my perspective, this is sort of normal course, and you should be able to compete for customer eyeballs, compete for wallet, and we think that we're very well positioned to be able to do that.
Obviously, it's only days with regards to what that platform will actually be, of the core focus of what networks and coverage will be on there has been covered. You obviously talk about the breadth of sports rights on the platform, and you call yourself a sports first platform. So how competitive really do you think that platform itself will be with what you're offering at the moment? Or do you think there's enough complementary nature that someone would subscribe to both?
Well, this is part of our claim, right? The reason why we're so bothered by this, and I'm surprised everyone here, well, I'm not surprised, because I think I'll never get a job in media again after this. But the problem here really is the consumer side of it. How many people have, at least 4 or 5 services to get the same experience you had 6 or 7 years ago? So it's gotten much more expensive, right? You can't find anything. And you find yourself, I don't want to use any company examples here because I know that'll be used against me at some point. But, the reality is, they put one game on their service, push you into a quarterly or an annual plan, and now you end up paying for the same content sometimes twice, sometimes 3 times or more. And so when you sort of aggregate all of that cost, consumers are spending probably around $10 billion or so in excess fees to get the same content. It's immoral. It's not fair. And, we have an obligation to stand up for customers.
And this is the whole thing that they're essentially trying to solve with Fubo, with them being as this, he keeps using the term super aggregator, where it's like you can get all these different, plan or add-ons and things where it's like you pay for your one plan, and then, depending on the type of content you want, you can just buy kind of those pieces and kind of put together, what you want. Because if there's other things you don't want, on these cable platforms, it's like if you're spending $160, $180 a month, you're getting, hundreds of channels you don't even watch. So that's, I wouldn't be surprised if Fubo comes out with a slimmer plan where it's cheaper than the $80 a month or whatever that Pro is starting at. They'll probably have something cheaper that they offer, and then people can add on to get more of what they want and not pay for all the additional content.
The quote that's come out of the leadership group there has been the fact that I think it was Lachlan Murdoch who said it, that he believes they can get to 5 million subscribers in 5 years. What's your just your view on how achievable that is, given given your experiences so far?
Well, when there's a lawsuit, you got to be careful what you say, so you don't want to make it sound too good to be true. So I would take it with a grain of salt. But again, there's so many examples. Look at Hulu SVOD, right? We all know the Hulu product. There has never been a competitor. That product is launched in 2008. Nobody has been able to build a service that can compete with it directly. You might be thinking Netflix or something else, but Netflix is 10 years older than Hulu. So, my view is that what'll happen is they'll probably start with 3 and then use the same playbook and get to 4 and then 5. And so they want to do it as quietly as possible. And, fortunately, there's someone like Fubo here to make sure at least that everyone can see the truth.
To look across the industry more widely, you talked about aggregation, and there's been a lot of activity on different types of partnerships and distribution deals happening. We're also seeing people like YouTube and indeed Amazon become much more of an aggregator than a single destination, and bringing a lot of different partnerships in place. How do you see those types of platforms and those types of approaches? Are they in a similar sphere to what the joint venture approach is, or is that, in your view, a different ballgame?
Yeah, so we always get that question, or like, how similar are we to these other, platforms? I would say, look, we're not an app store. We never claimed to be an app store. We wanted to create a unified experience where, people can get all their favorite content in a very personalized way. I've been talking about this for many years now. And so, the way I look at it is very simple. If you went in through like an Amazon interface, and let's say you were a big Cristiano Ronaldo fan, making this up, only because the rights have been so divided. So today he plays in the Saudi League, which is on Fox, right? He may still play for Portugal, and that might be the Euro Cup. And so you have athletes that you might want to follow that are playing in different teams, different events, or have, maybe they're speaking on different networks. And how do you follow an athlete if you're constantly having to jump around from platform to platform? You're never actually going to get the value out of your service. So.
And this is, I brought it up a couple times where Fubo's not trying to be an app store, and that's a huge distinguishing factor for their platform, because it's, you have your base plan, you add whatever Sports Plus package add-ons you want to add to your package, and all your stuff is instant. It's right there. That's where the value comes with the ad revenue, because with tracking user behavior and offering users the kind of content they want and suggesting things and really getting their engagement on the stuff they want to watch. You don't have this fragmentation of clicking on this app and going here. It's like you have the one platform, you can track all of their watching habits and things that they like, and that's where you can really drive the monthly hours for each user on the platform and really give them the most specific content, ads, things like that, to really get that value out of the content that they're watching.
So, we consider ourselves to be a premium platform servicing customer needs, and we've been at the forefront of innovation now for a long time.
So your business, and indeed the other businesses we're talking about, are very much still built on a subscription-first model.
Right.
What we're seeing a lot across the wider industry in other markets outside of the US is a real resilience or resistance, perhaps, from younger generation audiences to subscribe and put money up front for access to these things. They instead will use other platforms and other forms of entertainment instead, is the fear and concern, and particularly around non-live rights. You obviously have taken a hybrid approach in the monetization. Right. Do you see advertising becoming a continually bigger piece of the pie for access to particularly the live sports component of what you'll do, or do you think it will stay as a subscription model for the near to medium future?
Well, when we took the company public, we really sort of talked to investors about the dual revenue stream of advertising and subscription. I mean, sports is just too expensive for it to just be advertising driven. So it's definitely going to be a hybrid. Of course, we have our own network called Fubo Sports Network that's available, I think, 90 million plus homes at this point. And we do play some games on the free network just to kind of drive awareness for our partners, but it's highly unlikely you can sort of, offer sports, given the premium nature of different leagues, right? It also depends on the league, of course. But I think for the most part, it's going to be a dual revenue stream.
Across the industry globally, we have seen a downturn or a flattening of sports media rights value.
Right.
Do you think that's something that you're going to see more of in the US now as well? Obviously, a lot of deals have been locked in for longer term. NBA, we're waiting for what the outcome there is on those rights as well. What's your view on the future of the premium prices that sports properties are charging for those rights?
Well, I think taking the NFL out of the equation, because I think those deals are through like mid or 2031, 2 and 3. So I think there's time for that one. But for the other ones, look, I mean, this is the United States. It's a very competitive market, and as you see from the irrational behavior over the last 3 years of many of the major players in the market, they don't care, right? It's about crushing everyone for the sake of crushing everyone, including themselves. So, my view is that there's probably 1 or 2 more rounds of premiums being paid because these are sort of defining moments. One thing that I don't understand is why, the Amazons of the world want to own sports rights. I just don't get it, because they own the platform. So wouldn't you much rather have the NBA pay you a vig, as we say in sports, and you're still aggregating everything? So when I look at that to me is a little bit of a head scratcher. So we'll have to see what happens there. But I think that for some of the traditional media companies, because they're forcing companies like Fubo to pay for unwanted content, I think like they have to continue to pay up, or the writing's on the wall.
Right. In a few minutes, I will throw some questions to the floor. But just quickly, one of the things I saw you made a new deal with the MASN network, the Baltimore Orioles and Washington Network, Nationals home. That gives you something like, I think, 35 regional sports networks available on the platform.
Yep, that sounds right.
What role does the RSNs play on the platform? How important are they? Are they just one piece of many pieces of the puzzle for you in terms of attracting audiences, or are they more significant than that?
Yeah, well, look, I think we were the first ones. Well, we're always the first ones, but I think we've identified the RSNs as important components of our platform. If you look very closely at ratings, the reason why the RSNs never show up on any ratings reports is because ratings are national. So if you just look at ESPN, in any one market, you'll see that there's an RSN either very close to ESPN in that market, or you'll find that these RSNs are actually above in terms of viewership. And so we believe in the primacy of sports. Sports is local, which is one of the reasons why I think maybe you asked me before, like, oh, are you worried about Sunday Ticket? Does this change things for you around the NFL? And as you guys saw, we grew tremendously in the third quarter, despite the fact that the promos that YouTube was giving away were just insane. Like, only one company can do that. It's like Gmail. They can give anything away. And so, from my perspective, it's the primacy of sports. And
I think the RSNs have become a huge, really enticing for consumers to go to the platform, because they're really, I mean, if all you're watching are your teams, for this one, the MASN for Baltimore sports and some of the DC teams, things like that, people are going to subscribe if there's offered, just to have, pay that RSN independently, pay them whatever it is, $15-20 a month for a membership. The reality is a lot of people want other types of content. They like the aspects of cable without the cable prices. So I feel like that's kind of the intersection that Fubo is sitting at, where, instead of spending the $160 a month for cable to get those RSNs, you can get it, through Fubo for, $80-100. Because I don't think there's a ton of other options. I believe DirecTV Stream is really the other platform that has a lot of the RSNs. Correct me if I'm wrong. I think they're the other big one, but Fubo's been adding a ton of those carriage agreements with those RSNs. So I do think that is a pretty big piece of their business model.
We want to cater to customers in a way that they want to consume content, and to me, most people are local fans, right? I think if you look at just Major League Baseball Pass or any of the other passes, those services have never grown more than a certain level. I'm not going to say what that level is. Not because they're not good or people don't want to watch it. It's just because if you live in Boston, you're going to be a Red Sox fan. I mean, that's just a fact. So
the value of sports we've talked a little about. You don't see that really changing. You also have, I'm not sure how publicized it is, your international business as well, how much coverage it gets over in the US, but just talk about how that's tracking. You guys made an investment in Molotov, the French streaming platform out there.
Yeah, well, I always go back to, we probably have the best management team. Again, I go back to Moneyball. You don't have to take my word for it, do your own research. But, we took over Molotov, which is a French streaming platform, number 2 to Canal+, for a couple of reasons. One is we wanted to understand how international works. We wanted to acquire a solid engineering team. It was a very similar product, less sports-oriented, but very similar, linear. It's the aggregation of linear networks. And so, we took it over. I think they were doing about $7 million of revenue. 2023, $31 million of revenue. Gross margins went from, just call it almost zero, to north of 35%. It's all in 24 months with no marketing budget, and we've been able to drive subs from about, I think it was 80,000 to over 400,000, and we have over 1.2 million monthly active users. So what that allows us to do is, one, we've learned how to manage that, right? And number 2 is we're finishing up our unified platform.
I'm glad that question finally got asked and answered. I know that got cut off at the last earnings about the international piece, because I've honestly wondered the same thing. It's only $30 million a year. What's the point? It's such a small piece of what they do. But honestly, that was the answer I wanted to hear. They were trying to figure out the international piece. It sounds like they got access to a lot of some of their proprietary info from their engineering team, and just kind of how to run things a little more smoothly. And the fact that they've been able to grow it from basically like a zero gross margin to a 30% gross margin business really shows the efficiencies that they're bringing to the table. I'm honestly, that makes sense. It'll be interesting to see how they further develop that international piece going forward.
Which allows us to do some really amazing things. It allows us to add freemium onto the platform. We've rebuilt our whole subscription platform. So, obviously in all these markets, there's different ways that people pay for content. So we want to make sure that we have the APIs necessary, or be able to accept the APIs that are out there to be able to really deliver these products very quickly. And the number of edge cases is reduced with every entry into every market. So again, we're very, we have a long-term view, and our plan is to make sure all the technology is ready. Obviously, just want to be clear, we're not doing anything internationally at the moment, but we're gearing up for that at some point in time, post our free cash flow in 25, because we do think that there's a whole world out there that we can create a great product for. And I think what's also interesting, particularly in Europe, is that the antitrust regulation is pretty damn strong. So it gives us a nice way in which that we can sort of enter markets and not have to worry about, as I said, some of the bad behavior that we're dealing with in the United States.
And so it seems like he kind of touched on that unified platform that they're wrapping up now. It'll offer them a lot more efficiencies and optimizing the platform even more. And really, it sounds like that's kind of what they need to do to offer the freemium model, which is, the freemium model is just going to, he's kind of mentioned it. I think it was on the Q4 earnings call. It'll really create more of a pipeline where they can get people into the free model, and it kind of gets them into the Fubo ecosystem. And if people like it, it'll drive them to become paying subscribers. But also, it'll probably have a pretty big impact on their ad revenue. They've showed huge improvements on ad revenue over the last couple of quarters, so to continue to see that grow will be nice.
Before I look around the room for the questions, just a quick question on Molotov then, in terms of specifically around sports. Do you see a move into the live sports in right side in a market like France, which is not particularly buoyant at the moment from a cost perspective around those premium rights?
Yeah, well, of course, that's the plan. Right now, the brand is Molotov by Fubo. As we start to move into sports, we're having some conversations. We have the World Cup. We have a few other events on the platform, but we'll look to sort of expand on that over time. But of course, we want to do it in a way that's fiscally responsible.
Right. Any questions from the audience? If I can see you put your hand up, then I will. There we go. We've got a question right at the front.
The first question, do you ever thought about creating organic content for Fubo, your own content creation? Is that direction you want to go?
Yeah. So look, we have our own network right now. We have some licensing deals currently, but I think that I'm thinking about video more like Spotify in music, where you can use the artificial intelligence that we've been also building out. Again, we were first to market with that in 2021. Did I say first again? I feel like I say that all the time.
I think you did.
So I'm thinking more synthetic channels and being able to cater to your specific needs. Think of it as like Spotify has, like if you like rap music, there's a Rap Caviar, right? There's a station that you can access that kind of aggregates songs that the machine thinks are relevant for you. I think you'll see us start to do that in the coming years with sports talk, news programming. So I see us moving in that direction. We certainly want to differentiate from programmers. That's their job. Our job is to really create a super aggregation platform. So I think we'll probably stay in that space and focus on product.
That's really the first time he's spoke specifically on not creating their own content, really just, and it makes sense from the messaging that they've kind of been talking about, the super aggregation model. It makes sense for them to kind of stay in their own lane and just bringing all the other content from everyone else onto their platform rather than focusing on creating their own content. So to me, that makes sense with where they're going. The other thing about AI and kind of suggesting other content, he kind of compared it to Spotify, which I believe they have a guy from Spotify there who's working on creating that for them. I'm just surprised we haven't seen more of it. They have the favorites and stuff like that. I use it and your favorite channels, it'll pull them to the beginning, but it really doesn't suggest a whole lot. So it'll be kind of interesting to see how they implement that going forward.
Okay, another question?
Thank you. So you talked a lot about the Disney Warner Bros.
Right.
Fox streaming bundle. But at the same time, you also talked about how rights have been kind of too split up now. It's been very complicated for the consumer.
Right.
What do you think those companies should do instead? Given the fact that they're suffering on the linear side and the streaming side, what would you propose?
Well, I don't get paid to give other people advice. I've tried, that didn't work. What I would say is that, like I said, they're programmers. And if you think about the deterioration of the linear business, you have to say, why has it deteriorated, right? And the reason for that deterioration is because when you take content off of I'll call it the pay TV platform, I don't want to call it linear, and you're offering some of that content at below wholesale rates, you're driving people out of that ecosystem. And what I think has become clear to everyone, I hope it has, well, not to everyone. If you're on the 51st floor somewhere, probably not that obvious to you because it's still cloudy up there. But what I would say is that they need to really focus on, programming, the networks better, programming the content better, allowing us to provide better feature sets so that people are more engaged, which would drive sponsorship and advertising dollars for them as much as us. So, basically this is what you've seen over the last, 5 or 6 years is really a massive destruction of value that I haven't seen in any other industry. And all of this is due to basically just self-inflicted wounds and trying to find solutions for problems that probably don't exist, right? Who wants to have 50 platforms and go search and you're watching Thursday Night Football, there's a break, you want to quickly see another game or check out the news or do something, or the weather, and that's it, you're trapped, right? So again, I think at some point in time, what you'll see is that I think as investors apply pressure on these companies, I think they'll start to become a little bit more rational and allow us to do the work that we're supposed to do and give them time to focus on programming.
So I have one question at the front here, Rob.
Can you hear? Yeah, you mentioned Moneyball a lot. I love that analogy. It sounds like the fundamentals are strong. The long-term opportunity is massive. Why do you think Wall Street's missing this, and what do you think that you guys need to do to get them to care more and kind of fully value the company?
Yeah, good question. Look, when I say Moneyball, I mean not only the stats that I provided today, but if you think about it, we are probably the most expensive product in the market. And in 2020, I think we had about, don't quote me here, but fact check it, 500,000 or so subscribers to, I want to say, Hulu's 4 million or so. So we were roughly about 26 or 27% of Hulu's base in 2020. And today, fast forward, 37%. So better efficiencies across the board, higher prices, we're taking market share. You know, there's really is only one reason why investors have a hard time. And the answer is they don't believe that we can sustain the pressure applied, you know, from these companies. And so that's why I've been so vocal about it on our earnings call on Friday, because, you know, at some point, it's like a teenager spinning out of control. Like they tried everything. So this was just an opportunity for us to speak about something that I think not only impacts us, but impacts consumers. I mean, forget about all the junk fees. We're talking about $10 billion of fees that most of you are paying here. That is just unfair. I'm sure, you know, when you're at home talking to your parents or your spouse or your kids, and you look at your bills, you're like, what is this? Like a few $100? You don't even know when programming is on. So, you know, my view is like we just had no choice. They put us in a box, and you know, I've told them for many years, you know, if you want to, this goes for everyone in this room. When you negotiate with someone, you want to negotiate with them in a way that, you know, for instance, if you're negotiating with us, you don't want to push us over the ledge. You want to keep us on the ledge, but you want us to continue to engage with you and pay the premiums. But when you push someone over the edge, they have no choice. They're going to fight you. So
that was kind of a good way to close it out. I think this kind of goes back to the market capitulation that they kind of keep talking about of where things are going to this super aggregation model of keeping everything on one platform. And I think, you know, I think they're making all the right moves. You know, they're continuing to execute on what they need to. A lot of Wall Street's sleeping on this at this point. But it seems like, you know, he kind of threw out some of those metrics on there, you know, taking some of the market share from Hulu, or as, you know, growing their market share, you know, compared to Hulu. So it's, you know, they're continuing to execute, continuing to optimize how the organization is run. You know, it seems like they're making a lot of the right moves. But no, I thought that was kind of a good interview. If you stuck around this long, thanks for watching. Don't forget to like and subscribe. Also, feel free to comment if there's anything else you want to cover on Fubo. Thanks. See you.